Okay folks, so in this video we've got three violent things to discuss. Number one, the current situation with this market and what to make of the rally. Number two, the hottest plays and trade ideas heading into this week, like Revy McRevster, which had gone pretty damn crazy over the last couple of weeks. Is there more room to run? Well, we'll dive into it. And then lastly, we will be concluding with a big market and really overall economy catalyst that you need to know about. It's going to be dropping on Wednesday, and if you don't know what it is and you're not prepared ahead of time, well, it might drop on you like an A-bomb. Also, quick plug, our 4th of July sale on ZipTrader U has started, and you will get 50% off our program's one-time fee when you type in coupon code America50 before checkout. Take some time to consider membership this week and get access to our step-by-step lessons, private chat, daily morning briefings, and a plethora, yes, a plethora of other resources offered through the program. Link below. Okay, so you had a very strong ending to this past week. You had the Dow up a whopping 2.68%, the S&P 500 up 3.06%, the NASDAQ up 3.34%, and the Rusty's up 3.16%. On the week, you had the S&P 500 up almost 7%, Cathie Wood's flagship fund, ARK K, up 22.7%, Tesla up 15%, an incredibly green week for almost everything, right? And then when you go over to our lovely VIX, which measures implied volatility and essentially goes up alongside fear of future pricing uncertainty, well, you're seeing it drop to levels that we haven't seen since before the last capitulation cycle started. And to an extent, this should be deja vu because we've seen the cycle play out again and again. We know the trend is that the market does better after Fed meetings and does terrible before them. After the June 15th Fed meeting, we were talking about how we are in this never-ending loop of pain where you start with the data being bad, then the markets tank expecting the Fed to be more aggressive because of that bad data, and then the Fed is forced to be slightly more aggressive, but they still undershoot it by quite a lot, which means markets rally again because they're like, oh, it didn't have to be as aggressive as we thought. And so the market then sighs a sigh of relief and the markets rally. And then you go all the way back to step one when inevitably the next round of bad data comes out. This cycle has happened over and over and over again, and once again, it has happened again. But what's so cruel about these rallies is just how disorientating and common they are going to be throughout a downtrend and have been throughout other downtrends in market history. You look at the dot-com bubble bust period, some of the rallies in the overall downtrend here lasted not just a few weeks, but some would last like a month or two. And you go back to this particular cycle low here on September 21st of 2001. After hitting that, the market rallied pretty violently and made a new cycle high March 8th, 2002 until the downtrend restarted. Imagine that after seeing a period of selling off for about 15 straight months, all of a sudden, boom, you get 6 months of just uptrending and new cycle highs. You're thinking, oh, finally, we got a big reversal. Bullish. And then boom, no, massive sell-off again. And then you don't even get back to those prices for another 2 years. But that's the reality, and that's why you have to be very careful in terms of what you're watching when it comes down to the stock market. If you're trading on technicals when the fundamental catalysts that drive the stock market just aren't aligning, well, you're probably going to have a pretty bad time unless you're a very short-term trader. If you watch my videos, you know the big fundamental factors that I'm watching are number one, energy prices peaking, number two, food prices peaking, number three, company earnings actually starting to readjust upward instead of just keeping the downward trend. Number four, more reasonable valuations that actually factor in massive economic contraction. And then of course, finally, Fed trajectory changes, which that's going to be the big dog. And on any given week, you may see some fake outs that point to any of these economic catalysts being hit, but you need to see an actual trend reversal in all of them to really start seeing the market rally. And until that happens, as long as these factors are getting worse, I would not trust any uptrend in the overall market. Not a single one. It's almost like short-term bullish periods are just made for creating exit liquidity so big whales can get out at better prices and more easily. And as an unconventional indicator, recently I've noticed that I've started getting little gray hairs. Ever so slightly they've been popping up. Never before have I had this problem. It's a growing trend. It's not huge yet, but it's a growing trend. If you look very closely, it's very easy to see them. Now, these were not there before the Fed started tightening. You go back to January of 2021 where inflation was still going to be transitory and the stock market just kept going up. Not a single gray hair. People would comment every day on the channel saying, Charlie, your hair, it's just so beautifully black and masculine. It's just great. Then all of a sudden, coincidentally, 12 to 18 months ago, my hair starts turning more and more gray. And no longer do I get those channel comments saying you have nice hair. Now, where am I going with this? Well, you pull up a comparison between me and Jerome Powell. Jerome Powell is someone who is one of the most powerful people in the world. He can make the money printer go burr whenever he wants, and he could tell people that something is transitory for months and months on end and watch the most important currency in the world implode and still get reappointed to his job. And then you look at a schmuck like Charlie, a guy that likes sketchy spec plays like Redbox, who sits in his office and yells at a computer screen. For long-term conviction, he believes in falling tech companies. Everybody knows the tech companies are a fad. Get this poor bastard some ExxonMobil. So what advantage does somebody like a Charlie have over the Fed chairman, Jerome Powell? Well, one thing really, hair color. But as rates have gone up, Charlie's hair color has turned more and more close to Jerome Powell's. Powell is not fighting prices, he's fighting to turn my hair gray, and yours as well. Jerome Powell is an older man who has conquered almost everything in his life except for two things, hair color and inflation. The second one's pretty much a sunk boat. Look, folks, he's given up on inflation, but he knows he can set a new gray standard for everybody by slowly bleeding to death the stock market. Don't believe me? Go look in the mirror and see for yourself. I guarantee you, you'll find a few gray hairs, if not many. Or maybe you got gray 20 years ago. Well, that was Alan Greenspan's fault. Or maybe you lost your hair entirely. Well, that was Paul Volcker's fault. And let's be real, folks, the mainstream media, they're not going to tell you about this because they don't want you to know about it. They don't want you pointing fingers. They want to keep you in line and wearing hats. They're paid off by the hat lobby that knows that they're going to benefit if people start going gray or even losing their hair. Mark my words, the Fed will not lower rates again until my hair is completely gray. But at this pace, that's only going to be another 8 to 9 months. So hey, bullish. Okay, moving on to plays. Let's talk Rev. Madam Revi Ravina. She's been a good gal. We started briefing on her in ZipTrader U back on June 15th when she was at only around 230-ish a share. A little baby. But because of the bankruptcy contrarian trade dynamic and evolving catalyst, she's gone from that 230 to 989 at highs, which is about a 330% increase, which is great for a spec play. But now she's hanging around 795 and bounced some with the overall market on Friday. Is there more room to run? What is the setup looking like, Charlito? Well, Ortex reports that short interest is sitting just under 75% at an all-time high, which means new buy orders are bidding up prices a lot faster than otherwise would be, as it's becoming harder and harder to resell shares on the market for shorting. So why are short sellers so convinced that this makes sense to short to such an insane degree that they're open to a massive bloodbath if people start buying in mass? Well, the reason is because in bankruptcy proceedings, holders of shares tend to get obliterated at the end of the day. And that's almost always how it ends. Which means that if short sellers can hold on and they have the right margin situation where they're not going to be forced to close, well, they're pretty much guaranteed a profit. The only exception is if there's some sort of lucrative deal where they get bought out for a higher price than the average short price, but I don't see that happening. Short sellers have a justified reason to be convicted in shorting this. But markets don't care about justification, similar to how hedge funds can crush retail-heavy stocks to levels that make no sense fundamentally, while squeeze speculators, who are often in the retail crowd, can rally up stocks that make no sense fundamentally and completely destroy short sellers, forcing them to cover at a massive loss. But that said, practically, if you're trading this is a story that has already run quite a lot. At this point, the run has been successful, and I want to be very careful here. If you are someone who has rode it and are sitting on great gains and haven't locked in profits, well, it's probably very overdue for you to lock in profits. If you follow the ZipTrader risk management style, which I have free content on the channel in our trading tutorials playlist that covers that if you don't want to go into ZipTrader U, although the ZipTrader U content's a lot more in depth. But if you followed that risk management, you would have already sold, and you'd be waiting, if anything, for another proof of concept period. First and foremost goal, at least in my opinion, with any stock that's run up 300% for any reason, is to start thinking, okay, damn it, Sally, it's run up this much. Most stocks don't run up this much in 10 to 15 years, let alone a week or two. Now it's time to start thinking, okay, how do I lock in profits as fast as possible? And also, if I see another proof of concept wave, risk a small amount of capital to play that as well as a separate trade. I think, quite frankly, the odds of this continuing to run like it has are going down dramatically. The options chain happens to agree with me. You look at the options chain for contracts expiring at the end of this coming week, July 1st. The highest concentration of calls is at strike price $10 with open interest of about 1,430. You go over to puts, the highest concentration of puts is at $5, and you have a bit more than double the open interest at that point. In English, you have twice as much capital betting that Rev drops below $5 than is betting that Rev increases above $10 by the end of the week. Even if this hits some of the more bullish options at strike price $10, well, that's like a 25% increase. It's already up 300+%, right? So I think risk versus reward doesn't make much sense. I think that you could make an argument for trading it very, very short term with a very small amount of capital to protect your original profits. But aside from that, at these prices, it's not super exciting. Next, BHAT. So on Thursday, we briefed on BHAT at about 130-ish a share. It continued selling off into open, rejected a break of trend below our red directional SMA line, and then bounced up all the way to 422. Insane play, but then into Friday, it sold off and broke back below our red directional SMA line, which generally would indicate the momentum has died off a statistically significant amount. Doesn't mean it won't come back, but it does mean it's less likely if you look at 100 types of these trades and how they end up playing out. But the other point with this is that the reason it was rallying in the first place was largely because the company announced plans to shelve their public offering, which means less dilution, and people like that news, so they bought things up, and then people FOMO bought in, and then you had momentum traders, and all of a sudden you had this massive palooza of people buying in, which made this play work really well. However, that's not a catalyst that's going to last for very long. So I'd say for this one, hey, it's been good. I would consider very strongly thinking about the risk versus reward here and think, hey, maybe I should be locking in profits. Again, your choice, but my perspective. Next, BBIG. Okay, so you look at BBIG the last year or so, lots of spikes and dumps and tons of teasing catalysts. Everyone has been waiting for their Cryptide spinoff for quite a while, yet it just keeps getting delayed. Well, here we go again with another attempt at a spinoff date on June 23rd, this past Thursday, on Thirsty Thursday. BBIG said that the crypto distribution date is now set for June 29th, which is this coming Wednesday. So, we have a new catalyst on Wednesday. On top of that, on Monday, which is tomorrow, BBIG is expected to be added to the Russell 3000, which means you have two different catalysts this week for BBIG. Combining that with the fact that we're at traditional low levels of support where BBIG has rallied off of over and over again in the past, well, I think that BBIG has a fair chance at being a big play this week. On top of that, I would also look at the Cryptide spun-off shares as a trading opportunity. Next, Redbox. So Redbox has been a fun play, but as I've said since the merger details were announced, when the second half of 2022 starts, which starts July 1st, the risk versus reward no longer makes sense. The merger of Redbox with Chicken Soup for the Soul for much lower prices than it's currently trading at can go through at any point within Q3 or Q4 according to the details released. So this is really the last week I see Redbox as a real trading squeeze candidate, and I believe the market sees it the same way. Short interest right now, according to Ortex, is at 104% of free float. 104%, folks. If there's enough buying pressure, this could really shoot. The options chain on this is suggesting a high probability of substantial moves as high as to the $18 strike price. The $18 strike price calls are the number one most concentrated options for contracts expiring at the end of this coming week. Barely any concentration of puts lower than the current price. So you have a lot of money right now betting that, hey, this is going to be going towards the direction of $18 and perhaps exceeding it by quite a bit. And very little money, at least in the options chain, betting that this is going to go lower than the current price. Of course, in terms of actual share short, there's a lot of short sellers that think it's going to go below the current price. But in terms of people who are trading it week over week, a lot of people think this is going to shoot up a lot higher before it comes down. And I think markets willing, they're going to be right, but practically speaking, if you want to trade it, you need to see proof of concept, retention of value, and of course, once you get, or if you get some rallies to trade off of, you want to make sure that you're focusing on locking in profits as fast as possible, as fast as things start meaningfully turning against you. Okay, finally, we have a big catalyst coming this week, which is on Wednesday, and that is the next GDP report. Right now, we're in the situation where you're still going to see data before the Fed started meaningfully tightening financial conditions, and most of the impact of Fed policy doesn't have a huge impact on Main Street until maybe a couple quarters down the road, usually about 6 months down the road. But the economy is already eating itself from the inside because of rising costs. You look at the last report on Q1, you had a 1.5 contraction. This was supposed to be a growth quarter. Most of Wall Street thought this would be a growth quarter, but it contracted. And outside of Omicron, which did weigh down things on that quarter, the forces that drove Q1 should only be more present in Q2. And COVID, it might not be a big thing right now in the US to freak out about COVID, but obviously in China, which is a big global economy player, it is a big deal, because they're closing things down for 2 people sneezing. And pricing pressures here at home have gotten worse in pretty much every single category, which has eaten into a lot of ability to actually produce, ability to actually spend on things that aren't essential, and so on and so forth. Predictions, well, the Atlanta's branch GDP Now tracker is projecting flat 0.0% growth as of June 16th, and a lot of Wall Street analysts are expecting and thinking this is going to be an expansionary quarter, expecting a bounce back to 1.9% up. Others expect as high as 2.3%. I think that a lot of projections were very, very high coming into January of 2022, and a lot of analysts haven't wanted to 180 on their clients and say, oh, now we're expecting more contraction. So they've artificially kept their ratings really high, and they're just going to slowly downgrade it as time goes on. But to understand GDP and to really understand what's going into this number that you're going to hear this week, this is the formula for GDP. GDP equals private consumption plus gross private investment plus government investment plus government spending plus exports minus imports. So if you have more imports than you have exports, it becomes a negative number. If it's more exports than imports, it becomes a positive. For Q2, for example, we already know that consumers were relying more heavily on depleting savings to keep up consumption past inflationary pressures. So that's already curved in the positive favor. We know that private investment is down. In the case of government investment and spending, you've actually seen a dramatic drop year over year because of failures to push through different spending packages and the expiration of COVID programs. But quarter over quarter, that isn't going to look like very much. So you're not going to see the huge deceleration from that category. And then you have the trade deficit, which actually is decreasing right now because of record exports and production shutdowns in places like China. So that should actually be positive for the overall calculation as well. So you actually have a lot for this GDP calculation that is going to be curved in the favor of it being positive. So if we do see a contractionary quarter, you know things have gotten bad. At the end of the day, GDP is GDP, and if we get 2 quarters of contracting GDP, that's considered a recession. But I think that where the market's really going to be scared in terms of a recession is when you actually start seeing the companies that the market tracks report not just 1 quarter of lowering guidance, but a quarter where they're actually reporting really bad numbers, and they're still expecting another quarter of bad numbers and a worsening situation. Earnings recession in companies is going to be far more scary for the market than a GDP recession is. Anyways, that caps off the video. If you have any questions, feel free to reach out to us below or join us in ZipTrader Circle. If you want to get up to 10 free stocks plus a share with Lucid when you sign up with Moomoo with our link down below, make sure to do that. If you want to get 50% off our ZipTrader U program, the one-time fee on that, I'll put a link to ZipTrader U below. Make sure to subscribe and hit that ravishing like button, and I'll see you in the next one.